Hello, I'm delighted to have with me today Doug Ticus and Kris Oxtal, who are co-authors of our Capright Self-Storage Update.
Hey, Steve.
Welcome.
Thanks for having us. Pleasure to be in person talking to you, and we're glad to be here.
Glad to be with you, Steve.
Yeah, it's good to have you both with us. The headline of the Self-Storage Update indicates some softening in the market. Can you tell us why this has happened since we last spoke?
Yeah, Steve, that's a great point. I think there are a couple factors at play here. A slowing housing market, which is always a demand driver for self-storage, is up there at the top of the list. Combine that with a little bit of supply issues, and you kind of have a recipe for a little bit slower demand. I think that there's overall good things ahead, but a little bit of soft spot now.
Yeah, we've definitely seen some oversupply in some of the markets that were easier to build in, and that's really put pressure downwards on rents. But in the current environment, it's difficult to start new construction, so we should see some of that oversupply burn through in the next few months.
What about the headwinds of high operating costs and the increasingly high cost of capital?
Yeah, that's hitting the bottom line of all operators. In addition to softness on rents, the big four REITs are projecting increased expenses, which, as the latest guidance from the four, has resulted in negative NOI growth over the next year forecast. Now that's at a macro level, so each individual property and market will be a little bit different, but there's certainly pressure on expenses and operational costs.
And combining that with the high cost of capital makes new construction really difficult to pencil right now. So again, that'll help with the oversupply in some markets.
Yeah, well, you talk about REITs, Doug, and there appears to be quite a gap between the REITs that use all the latest tech efficiencies and the traditional mom and pops, what we call maybe legacy. Can you explain that?
Yes, that's certainly the case. The big REITs and the other institutional players have a few advantages in that. On the operating expense side, there's some efficiencies in terms of scale, since they own and operate so much that they can gain some advantages there. The other big thing that they have going for them is data collection, and that can impact rents greatly and how they're projecting their rents moving forward.
Yeah.
Yeah, and it really becomes an art and a science where, you don't want 95% occupancies. That means you're not pushing your rents higher, right? 80s, low 90s is usually where you want to balance into. So it's a little bit of testing the waters and seeing where customers are at.
What about the policy of existing tenant uplifts? That it looks to me like the bigger operators can.
Yeah, so a lot of the REITs are offering very low rents to get you in the door right now, with plans to push you up 20, 30, 40% over 6, 12 months. And that's a big driver of revenues over the next 12 to 18 months.
Yeah, that's definitely a difference from mom and pop operators who are typically more focused on occupancy and don't have those ECRI increases as much. They have some of them, but the biggest ones are coming from the REITs that get seats in the butts in the seats at lower rents and then push those rates.
Yeah, well, mindful of these headwinds, and I know you're not saying the sector is struggling, but how long before it picks up the pace again?
Yeah, well, I think there's going to be a couple factors that determine that. I think the midterm outlook looks good. As Kris mentioned, we're going to probably see construction abate given the high cost of capital and those numbers not totally penciling out. That will help in the midterm, and then what will really be the kind of match that lights the fire, in my opinion, is interest rate environment either decreasing or comfort at the current levels. That will create more housing sales, which will be a big driver in the demand side.
Sure. Yeah.
I'd agree with that. To reiterate what Doug said, the housing market makes up a lot of the storage demand, so we need more transactions to get people moving, and that causes demand for storage. So near term, a little bit of difficulty, but longer term fundamentals
So we need
are strong.
mortgage rates to come down.
Yes.
The key.
Yes.
Yeah,
Come
yeah,
down or pricing to come down. So
right,
one or the
Or
other.
both.
one or the other.
Yeah, sure.
If it stays higher for longer, then you're going to need to see pricing come down. But it's tough with 30-year fixed mortgages for that pricing to move significantly. Where, when we're looking at commercial real estate, you have shorter terms, and those are coming due.
Yeah. Well, it's an interesting phase in the cycle in this particular sector. So thanks for coming in to share these fascinating thoughts with us.
Great, thanks, Steve. Appreciate it.
Thank you, Steve.
You're welcome.